Here we are. Okay. We're going to go ahead and start off, as we typically do in this session, talking a little bit about what's happening in the broad market, and then we'll dive deeper into what the market internals are doing in terms of relative performance one against another. Today, we're seeing the S&P 500 up just a hair, only 5 basis points presently. It was a little better earlier, but it currently is sitting right there at just a few points positive. As we take a look across the various sectors, it looks like that's almost unanimous. Everything approximately right in there. Financials more substantially down, energy more substantially down, and consumer discretionary offsetting those up by 1%. But on the whole, most of them somewhere around 0.25% down or so. Continuing our search for what's happening in the markets, here's an interesting look in terms of what's been happening since the end of last year. Our uptrend lines still in force, still something to be aware of, but the areas we've been watching over the course of the last few weeks and month, this strong upward trend unfortunately seeming to have given up entirely, now showing itself to be questionable. And at this point, it's now the bulls who are hoping that there is enough strength in this trend in order for it to find its footing and start moving higher again. Unfortunately, there's not a lot of momentum. It's given up some of that, at least in terms of the most recent push. Ever since about a week ago, that's been the case. Effectively just sideways action since 1 week back. But today, we are finding another green candle and slightly positive presently at 54.72. We did 1 week ago find our way up to 54.99 at the open, and by the high 55.05. But unfortunately, we haven't seen the north side of 5,500 ever since. So it's been a question ranging here in the minds of you and me, everybody watching the markets, whether we're headed next back to 5,500 or if we're going to need to visit 5,400 before we escape from this small little range. Those certainly would be the areas with key focus to be watching, 55 and 5,400. As has been noted in this class and several others, also the midpoint between them right here at 54.50, an area that the market has respected in terms of support thus far. If we are going to head to 5,400, likely 54.50 will be that first domino to fall, moving us in that direction. Today, we're going to dive in and take a look at a few different ideas, and I see what's going on. Let's see, I see at least one report saying there was a little bit of trouble getting logged into the session today. Did anybody else experience any trouble getting logged into the session today? Go ahead and just hit one of the emojis or raise your hand, and I'll see that. But sorry to hear that that was the case. Hopefully technology is not going to be prohibiting access to the session today. Let's go ahead and move forward. Our first dive into the material is going to be this one, where we'll take a look at the relative rotation graphs. And I did see your question, MA, about what these axes are and represent. It's been a little while since we've talked about them, so I'll go ahead and break that down in a little greater detail today. But here's what we are seeing as we take a look at the scaling. This is the relative rotation graphs, which comes from the Relative Rotation Graph Company. Specifically, this one was pulled, as the disclaimer says down here at the bottom, from Bloomberg. And what's happening here is it measuring out the relative performance of each of the sectors of the market compared to each other. There are two measures. There's the relative strength momentum. Does it have more momentum than the others? And then there is the relative strength ratio left to right. The relative strength ratio is looking instead at the relative values and how those have changed. And then the relative momentum is saying how quickly does that individual security have momentum presently. So what tends to happen is a security picks up momentum, starts going up, and as a result of that increased momentum, it gains on the relative price metric and moves to the right as well. Then as the momentum wanes, as we start going back down, that tends to also make the relative price also lose ground. That's what creates this elliptical or kind of rotationary movement on the graph over time. Currently, we're seeing a clear leader in the S&P 500 Information Technology Index, dramatically outperforming on that side. So it's substantially different as we take a look and see on here. So information technology doing far better than the rest of the market. In fact, it's the sole security on the right-hand side of our midpoint line here in terms of the relative price performance, that relative price, the relative strength ratio. Everything else currently to the left-hand side, that's partly because of the huge strength showing up in the information technology sector, but also due to lackluster performance from these as a whole. As we take a look, communication services is the closest to the middle. We've got consumer discretionary up here gaining some steam. Our sector of focus today is real estate, which is this dot right here. And its trail is this one that comes right on up and ended right up here in the middle. It has lost a little bit of its luster, and we'll take a look and see how real estate has reacted over the course of the last few weeks. But that's the breakdown, hopefully, on here, MA, of what's happening on this relative strength. The goal is to recognize what's changing, and these are representing 1 day per little arrow on here. 1 day is what's represented. So this is only the most recent 1 week's worth of performance. Utilities doing rather poorly over the course of that particular week. I'm sorry, I said 1 week, but it's about 2 weeks worth of trading data. Next, we're going to take a look at our sector performance sheets, and we're going to do so in light of this one right here. Okay. We're going to take a look at first our month-to-date performance. This is how we've done month-to-date. So June performance and performance alone. This is where I said, yes, information technology, no wonder it was far over there on the right-hand side on our relative performance. It is personally up 10% alone, this solitary sector. That is a strong performance from information technology. It's also had strong performance from communication services and consumer discretionary third in line, and that's the first time we've seen that occur in some time. Though it is reminiscent of this graph, this one is the 2023 year-long sector performance, where those same 3 sectors were our leaders, all 3 of them outperforming the index as a whole. If we come back and look at June alone, 1, 2, 3 in that same order, and the S&P 500 not far behind. Very similar to that year performance. Similar as well to 2023 performance, we have both utilities and energy negative. However, this is where it deviates. Financials, real estate, materials, industrials, all negative. Those 4 were positive over the course of last year. This one is seeing a bit of a change and a lot of things either flat to slightly down. We'll notice on our up and down axis, this isn't by a huge magnitude. Materials down more than some others at 3.5% down, but financials, real estate, industrials, they're only off by about 1.5% or so. Nothing to necessarily fret over, especially since many of these still are near their all-time highs, but we'll take closer looks at least 2 of the charts here later on. Healthcare, slightly positive, adding 2% over the course of the month. Staples, almost flat at this point. So over the course of this last month, information technology has made up a lot of ground, but it did suffer just a little bit. Here's its performance again in the month of May. And you can see information technology again leading in a big way. Almost everything was positive over the month of June. I'm sorry, the month of May, and now we're seeing instead in the month of June a little bit of weakness in some of the other sectors showing up. If we go ahead and jump over and take a look at one other, I wanted to show our year-to-date version of this same graph. Here it is, starting at the start of the year, coming through till present. Now, 2 strong months of performance in a row for information technology has been enough to put it back in the driver's seat year-to-date. In terms of price performance, communication services still way up there. But I pointed out that though June had consumer discretionary strong performing, it has not been the case year to date. In fact, its positive performance has almost entirely been as a result of this month. It has done almost nothing until then. But we have one sector and one sector only negative year to date, and that's real estate. We'll take a look at this one in great depth. But the S&P 500 now positive, almost 15%. This is on a purely price performance basis for all of these values, as opposed to total returns, which would include potential for dividends reinvested over time. Real estate off 5.5%, almost 6% year to date. Not what you'd like to see if you're a real estate investor, but perhaps there's opportunity in the future depending on where things start to go with interest rates. Here we are, ready to take a look at our next idea. So we've looked at our relative rotations. We've glanced over some of our sector performance. Now we're going to see this in another format. This is a custom-built set of heat maps that I put together for you each week. This one's showing us our performance just over the last week's worth of trading activity through yesterday's activity on this one. Yesterday's activity culminated with a pretty red selling off for the semiconductor area. Specifically, NVIDIA represented a 7% loss. It was down much more at some points along the way. But yesterday did represent a pretty impressive comeback for NVIDIA, adding almost 5%. But nonetheless, the sector or this industry lost 6.5% over the course of the last trading week. On the flip side, positive performers, we had interactive media and services, specifically Google, adding substantially 5% over the course of the last week, Meta adding 2%, AT&T 3%, media in general adding 3.5%. Down here, the energy sector adding 4%, a few other strong performers in here, but the big loser and something dragging the market was information technology this last week, even though it's maintained some strength on a month-to-date basis. Again, this is 1 week, and watch as I flip this over to show us 1 month's worth of data. 1 month's worth of data, suddenly we see how short-lived so far that short-term selling has been. NVIDIA still up 10% over the course of the last month, even though it's down 7% over the last week. Clearly has had an outrageous run up. Apple up 10% over that same period. Down here, we see Oracle, CrowdStrike, Autodesk, all of these up in a big way, 15% here. TJ Maxx adding 9%. And in the real estate sector, we see positive performance, 2.5% positive for the real estate sector. Now, as we start to focus in on real estate and think about the performance here, I'd like to highlight a few things. First, like we did before when we became familiar with this sector, we noticed that the industries inside of it are specialized REITs, real estate investment trust is what REIT stands for. These real estate investment trusts are either some sort of specialized version, residential versions, healthcare versions, industrial versions, retail versions. Clearly, real estate investment trusts, in other words, companies whose sole purpose it is to buy, acquire, and manage property over time, are a large part of this sector as a whole. Down here in the bottom right, we see hotels and offices also on that listing. The only part that's not is real estate management and development, where we see companies like C.B. Richard Ellis. No relation to my own family name, though my dad did work there for the majority of his career. Good company. But real estate management and development, down 5%. 5%. So, as we think through the performance here, one thing that's notably absent from the real estate sector is this. In response to a comment I received several weeks ago in this class, I do read through all the comments, even if I don't get to address them during the class. This one said, hey, I've learned a lot from your class. First off, thank you. But then you say that you've noticed some ETFs like XHB and a couple others in the home building industry have beaten the NASDAQ over the last several years. Could we talk about that in a little greater depth? You might have thought that in the real estate sector, we would find those types of companies, but they are notably absent, and that is intentional. They were divided out of there and instead find their way into the consumer discretionary, specifically down here in this corner under household durables. Household durables over the last month, we see D.R. Horton, we see Lennar, and several other home builders and home goods producers here really failing to shine over the course of the last month. We will take a closer look at this as it is clearly adjacent to the real estate sector, and we'll talk about this in a few ways. So I'd like to step away from our heat maps now and take a look at a couple of the economic reports that came out first thing this morning that perhaps you already saw, but if not, it's time to review them together. There was two real estate important announcements this morning. The first one is new home sales. The new home sales came in at 619,000, substantially under the estimates. Estimates range from 622 to 666,000. Unfortunately, 619, not quite cutting it. In other words, less movement going on, less home sales being finalized during the course of this month. That's not necessarily a bellwether of what's happening in the economy, as this is simply how many homes traded hands. It's not talking about the value of those homes. It hints at the underlying reasons, flexibility in job movement and other things like that. However, the report does signal that likely the reason was related to interest rates, as interest rates have hovered around 7%. And for a greater look at this particular idea, if we go ahead and take a look instead at now the MBA mortgage applications information, this also was a little bit less than the previous slight decreases in the or the week over week performance. Each week we get an update on this particular facet. But it did point out a few things, including that the 30-year mortgage rate now coming in just less than 7%, 6.93% is the current rate sitting in on here. So we'll take a look at how interest rates play in with some of the real estate performance as we think about these over time. But we will leave those economic reports in their spot. Anybody who wants to find these for greater detail, go to News and Research, click on Economic Calendar is where we found those two reports we just took a glance at. But next up on our docket is to go ahead and swing through and take a closer look at some of the other data that we get from our third-party resources. This one, again, coming from Bloomberg. I used in past weeks several different screenshots and visuals provided thanks to FactSet. Our trial access to that particular data provider has ended. Thank you for your feedback in terms of what you enjoyed and didn't about it. We're now working on seeing if that can't become something we have access to permanently, or if it will be Bloomberg that stays or some other data provider. But here we're looking at some of the data from Bloomberg. In this case, diving into the real estate sector, and specifically what we're seeing here is the breakdown of its revenues. Where does its revenues come from? These are the companies inside the real estate sector. And we notice that only 66% of its revenues are generated from the real estate activity. The rest is coming from things that you might categorize as industrials or communication or technology or some other ancillary functions. And that's where we're getting this change in the breakdown. The other ones that we've taken a look at in this same vein were healthcare. We looked at it a couple weeks ago as well when we dove through and looked at materials, in which case both of them were strongly concentrated exclusively in that. So for comparison purposes, I brought up the healthcare one. 98% of its revenues come exclusively from healthcare, just a touch of consumer staples sprinkled into their overall revenue generation. Not nearly as concise and clear-cut in the real estate sector. Though they are real estate companies, here we start to see how broad that might stretch and instead seeing that deviate a little bit from the total. So when we look at real estate, we recognize that we do have some exposure to other parts of the market as a result of that ownership. When we think about its performance over time, this is an opportunity for us to think about seasonality. So here we're looking at our first seasonality graph. After your feedback last time, here's what I've been able to produce to make this a little easier. We're looking at the 20-year high, so the best performance for a single month for the real estate sector was April at 34% positive. On a 20-year average, what's the average for each of those individual years? The month of June has tended to be slightly down, off 0.66. We're off 0.5% this year, certainly in line with that average. And then we also have our 20-year low displayed for us across the board. As we glance across our middle line here, our average, we can certainly see the way that we've seen the real estate sector have strong price performance for many months in the year, but September has tended to be negative. Its best year, only 7% positive, average down 1%, almost 2%, and 13% off in terms of the worst. Now, as we glance forward, even though the average for October is 0.61, it managed to be positive. There were several large negative performers over the course of that 20-year period, showing a certainly a possibility for risk there in October as well. So seasonality, there is some showing up seasonality for the sector. If you wanted the detail on where this comes from, we decided this was just a little bit too many boxes to really get a lot of information from all at once. Our top 4 rows are the same that we just saw on the previous page. You're welcome to take a screenshot of this if you wanted to look at it in a little closer detail. I'll leave it there for just a moment longer as we do. But the next thing we're going to take a look at is an understanding of how the sector has performed relative to the S&P 500. And I've also included now the home builders as well. So our white line on here, white line is representing the S&P 500. The orange line down here is the real estate sector. And then up here in yellow is the home building sub-industry for this. So clearly there has been a big discrepancy between these. As we measure them out and see their relative performance, here's what we're looking at. The total return of each of these. None of them lost us money if you started way back here in 2001 and held on until present, but there was substantial outperformance by both the home builders and the S&P 500 compared to real estate. Real estate underperforming during that time frame, only managing a 5% annual return. But if we zoom in and take a look over the last 5 years instead, some of those same trends hold up. Specifically, the outperformance by the home builders index yielding 226%, a full 200% better than the return offered by real estate, whereas the total return for the S&P 500 was an effective doubling of your initial investment over the course of the last 5 years. That's a big difference in relative performance, and clearly if home builders had been included in the real estate sector, maybe things would look a little bit brighter from that viewpoint, but it's worth taking a look at the home builders as it's been a strong performance during this time frame as well. We'll glance at one last chart from the third-party sources, this one showing our price to earnings ratios over time and showing what's happening presently. Right now, we're seeing the forward estimates of earnings at 18.15, not very high. In other words, saying that earnings are expected to grow pretty decently. As we look down here on the recorded price to earnings ratio, also in relative lows, not nearly as expensive as it has been in some other cases. So that's a lot that we've dove through in this last couple minutes. Next, we were going to take a look at the sector screener that I put together for us. This is downloaded data from fidelity.com and then sliced up and reformatted to show in a maybe a little bit easier to make use of way. In this case, aggregating by sector and also displaying any of the characteristics that we've downloaded from the sector screener. There was a request after the class on how to build this on Monday that I could show one more time the steps involved in building it so that you can grab a screenshot of it. So here are those steps. It's a lot of steps. If you weren't present in the class on Monday, I apologize. This may look like mumbo jumbo. It may look like mumbo jumbo even if you were there. It's a lot all at once. But this is the first page of those. Go ahead and grab your screenshot if needed. And then I will be scrolling down in just a moment to show the remainder of it. Okay, go ahead and grab your screenshot of the bottom half of this, the second page of these updates. Things to be aware of while people are grabbing their screenshots, getting that update, is the real estate sector is relatively small in proportion to the other parts of the market. It has some 30 or so stocks, not small in terms of the number of stocks necessarily, but the size of those stocks is relatively small. If we go ahead and jump in and take a look at the real estate sector and its various industries, we see that the overall return across any of these industries has varied pretty substantially. The worst performer over the course of the last 3 years, perhaps this comes at no surprise, is office-focused real estate investment trusts. These are trusts that own office buildings and rent them out is their main business. And as a result, unfortunately, have suffered rather poorly as a shift away from working in offices has persisted in the wake of COVID-19. Some have recovered, but unfortunately, the office real estate space is not quite the same, and commercial real estate in that area has certainly suffered over the course of the last several years. Meanwhile, there's been positive performance by a couple others. Hotels rebounded over the course of the last few years post-COVID. Retail real estate investments have done a little bit better. But as we come over and take a look, clearly there is some broad discrepancy showing up, a lot of speculation showing up in terms of the pricing for these, including a PE ratio of 91 on average for the healthcare real estates, even on its forward estimate coming through at 70, implying there's a lot being paid for these real estate investment trusts currently. We'll take a look and see how that is represented in a couple charts here as we wrap up the session. But the individual securities that we're going to be taking a look at come from these various sectors. They're sorted in terms of their largest market capitalization. We're going to take a quick glance at VTR at minimum as we wrap up the session today, already coming through to the close of our traditional time. We'll go ahead and swing over and take a look at that on the charts. First, we'll take a look at XLRE, the real estate investment ETF from the SPDR funds. We can see that every time it's tried to move positively, there's been a decently strong downtrend that has come up. And that's what's going on right now. A very recent support and resistance level at $39 per share, and then a new downtrend showing up, fighting against what has been a 3-month-long uptrend. Unfortunately, yesterday's strong sell-off and today holding in that same range, even losing just a little bit again, is putting us well below the trend line, even fighting our way to one average true range extended beyond that trajectory. Real estate in a moment of real crisis here, if it can't find its footing, it's quite possible it may move its way downwards yet again. If we take a look and swing over to the home builders ETF, I'm sorry, XHB is the symbol. This one is finding similar things in that its uptrends have unfortunately failed, but here it finds a strong reason for support at the nice round $100 mark. It's fighting with that area right now, needs to find its footing, and for a third or fourth time prove that $100 is too low for this and move back upwards while contending with the downtrend line. I'd like to point out here over the course of the last several years and compare this against .TNX to show how they have often moved in juxtaposition. We see that when the home builders are going way down, 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 that has been in some cases because rates are going up, up, up. TNX is a representation of the 10-year yield, and though it's not precisely correlated with mortgage rates, we would find that if we graph these in conjunction with mortgage rates, the pattern would be that much more clear. This period showing almost perfect negative correlation, where when home builders is going down, it's on the backs of increased rates, and vice versa. Home builders finding their way to their recent highs. Why? Because there was an expectation for a decrease in interest rates coming through the turn of the year, entering into present. I did promise we'll take a look at one individual symbol. That's VTR. I had prepared a couple of others to take a look at. We'll get rid of the 10-year yield, but this is its performance over the course of the last 5 years. That's not a strong looking chart. Unfortunately, this one makes its way onto our list because it was the best performer for real estate for the last 13 weeks, the last quarter's worth of performance. And where did that quarter's worth of positive performance put it? It put it just right here at an area to prove what happens next, lining up our previous peaks and coming in now on the most recent activity. Maybe we'll zoom back into just 1 year's worth. It has moved strongly from $40 back up to $50, a 25% price increase over the course of just the last month and a half, 2 months. But nonetheless, it is now at an area of decision point. It needs to break above 50 in order for this to be sustainable. And yesterday we closed below it. Today we're fighting to get back above $50 per share. Be watching this closely if you intend to have exposure to it. Ventus is one of those that operates its model largely off of senior housing communities. So it's a healthcare focused REIT specifically. That was a whirlwind of 30 plus minutes of information. I hope it wasn't too much too quick, but I'm going to go ahead and cease presenting new information at this time and instead shift over to answer your questions as best I can. Thank you for your patience in waiting for those questions to be addressed. Your feedback is always highly valued, and I'll do my best always to integrate it into the sessions. All right, let me take a look and see. All right, Russell, I hope you were able to grab a copy of those notes. It looks like you were one who might have benefited from seeing those one more time here. Yeah, Bill, the sector rotation graph on black background, I agree, is a little harder to see. It actually is really easy to see on my screen. But we found that when we share a dark background, often over the screen share, for some reason, the way that Zoom compresses it and then re-expands it to you, it gets a little bit difficult to see. So hopefully I'll be able to find some way to make that a lighter background so that you can see it. I prefer the Bloomberg one that I had displayed over the white background we've looked at in the back in weeks past, because it's real-time data, including today, as opposed to a little bit dated data. Each of the dots on there, Frank, represented 1 day's worth of information. So if we go ahead and swing back over to it, this one here. Every one of these little arrows represents 1 day's worth of data, and the final dot is our current activity. Let's see. Moses, you're saying that maybe the screen share wasn't updating. I hope that didn't last for long, but thank you for your feedback. Let's see, MA, technical indicator. MA, there is, MA is asking if there's a technical indicator that we can use for the relative strength momentum that can be used by itself. The version that's used here, this JDK RS momentum, is offered at some institutions as a technical indicator that you can graph instead of this two-dimensional kind of a graph point. Instead, it would just be as a typical one-dimensional up and down line over time, the way all of our other technical indicators show up. I know that stockcharts.com offers that, MA. I don't know that it is available anywhere else, personally. There are many different real estate investment trusts. Emmy, yeah, good question. As they're all a little bit different in those the types of real estate investment trusts, lumping them together does make some sense, as there is some correlation between the various industries inside of real estate. But it always surprised me as we take a look on it. Let's see. Looks like we need one more opportunity for screenshots. Whoever it is that's on iPad and said you missed screenshots, let me know what you needed on there. I'll go back. I'll pull up whatever you needed to screenshot again. Just let me know which one you are looking at. Okay. Excellent. Um, the heat maps that I was showing, this version and the following page both come from Bloomberg. So these are not created by me personally, though you could certainly do something similar if you have access to the long-term data. That's the big thing that Bloomberg has been able to provide. Sector-based information is hard to find going back 20 years. Often you can only get about a decade's worth of information before you start to run dry of price performance accuracy. And so that's a nice feature from some of these third-party resources. They are paid and they're expensively paid platforms. That's why we have to make an argument that we can get the value needed out of it. Let's see. These are total returns that I'm displaying on here as well as down here. These are total returns in both cases as we were taking a look at all of those. The only ones that were price performance were my personal graphs, which look like this one. These are price performance graphs. These ones are price performance graphs. All the ones that we looked at in Active Trader Pro are price performance alone. All right, it looks like it was maybe this stuff that was needed. Here's page 1 again for anybody who needed the Excel steps. All right. Okay. I see. I'll go ahead and flip through those one more time on the first several screenshots that I showed. As we take a look, thanks for letting me know it wasn't showing up in the browser. I don't know if that's something I can fix, but certainly appreciate it. Let's see. The heat maps that I create is something that I do using my knowledge of the Python programming language, these ones that I use. That's not something that we offer as a service to teach people how to do. It's a little bit more in depth and is outside of the scope of what we discuss. So unfortunately, that's not something that even calling in you'd be able to get access to. There are similar ones that you could access from FinViz. FINVIZ, another third-party resource that you're welcome to go ahead and hop in and take a look at as well to get a heat map of similar information. The class on Monday that I taught was Ready to Excel is the title for it, where I've showed how to create some of the different Excel spreadsheets that I've made over time in order to make use of the data that you can download from fidelity.com. So this past Monday, I taught this particular one. I usually only run that about once a month or once every other month, as it's a little bit more of a niche topic. Not everybody is interested in it. But Teresa, that was taught this last Monday, and we showed how to do this one. The sector heat map that I create, this one, the data for it actually comes straight from Fidelity's stock screener. So what I do is I take the stock screener. I've got some columns that I like to show and that I've already built. As a result, I save that to be easily repeatable. Then you click download results to plug those just into Excel. Then specifically, I've created some connections with that and manipulations to aggregate all the data over time. But it's including information like the sector so that I can dissect that on that basis. James, you're wondering if the class was recorded. All of our classes are recorded, but none of them are later published. They're recorded exclusively for compliance purposes. I will let you know, though, when that comes back up on the rotation again. Okay. It sounds like there has been recurring issues with the web version, watching through the browser in Zoom, and the native Zoom app, Dave is saying, has been more consistent to follow along with the screen share along the way. VJ, you can do almost everything that I do in Excel instead in Google Sheets, but not quite everything. Specifically, Google Sheets I've found lacking in terms of visualizations, making graphs. Other than that, it's at least up on par, in some ways even superior, depending on what you are attempting to do specifically. But Excel is certainly my preference in terms of overall strength of processing. All right, everybody. Thank you so much. That looks like I think I hit almost all of the questions, but I'll review the feedback as well. Thank you so much for joining with us. I appreciate the time and opportunity to share with you. This was, again, Jake Talks Sectors. Today, our focus was largely on that real estate sector, but I hope you walked away with some important thoughts as well about home builders, which is a little add-on that we threw in this time around. We're coming up very soon on the start of earnings season. We'll probably hit one more sector before circling back to financials, as financials often leads us out into the beginning of earnings season. And then we'll swing back through the largest sectors to make sure we're focusing on those as their earnings are coming out. So I appreciate your feedback and thank you for joining with me over the course of the past weeks. And I hope to see you back same time next week when we dive right in and do so. Next week does happen to be July 3rd, the day before Independence Day. The markets do take an early close on those days, but nonetheless, our session will be scheduled at the regular noon block. I believe we'll be adjusting our afternoon market brief to happen right at market close at 1 p.m. Eastern time. So we'll take a look. Be aware that the schedule may adjust just a little bit over the course of time, but I'll look forward to being back here with you 1 week from today for the same content. Thank you. Wishing you the best. Take care.